Howdy, Team 42. It's your skipper here at Darius Dell to present our macro minute for Tuesday, April 22nd, 2025. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is it time to buy the dip? Our answers are U.S. stocks are rebounding after Monday's sell-off as the U.S. claims significant progress toward a trade deal with India following talks, or significant progress toward a trade deal with India following talks between Vice President J.D. Vance and Indian Prime Minister Narendra Modi. It remains our base case that the bond market activated the Trump put on April 9th. As such, we continue to anticipate a series of positive trade negotiation headlines over the coming months, ultimately a cascading sequence of trade deals that do very little to move the needle for the Main Street workers that the Trump administration claims to be focused on. Said differently, we believe the bond market sapped the Trump administration of the resoluteness required to facilitate an expeditious transition from Paradigm A, which is a bloated K-shaped U.S. economy propped up by excessive fiscal deficits, to Paradigm B, which is a bloated E-shaped U.S. economy propelled by the private sector. Everyone agrees with our relatively sanguine view, and that is worrisome as a firm that is attuned to how the fourth turning poly crisis is likely to impact the economy and asset markets, as anyone not named Ray Dalio. For example, we've been abundantly clear that a full-blown U.S. balance of payments crisis is not our base case scenario, but the fact that we see the risk of one as much higher than most investors are prepared to believe suggests the selling of U.S. stocks will be intense and long-lasting if one does occur. Secular bear markets occur when everyone believes one structurally bullish thing, and that one thing turns out not to be true. The permanence of U.S. exceptionalism and its independence from the chronic abuse of exorbitant privilege by the U.S.'s private and public sectors are two structurally bullish beliefs most everyone assumes to be true that may become false if the Trump administration continues to accumulate policy blunders during this geopolitically precarious time. Transition to our 42 macro dashboard. As always, a wrap up the question from our community. This one's regarding replacing U.S. Treasury duration with gold. It says, I truly appreciate and admire the work you're doing. Thank you for the consistently valuable insights you share in helping us grow. I'm currently in the process of adjusting my portfolio by transitioning out of long duration U.S. Treasuries and increasing exposure to gold. Given the strong extended price action in recent weeks, I'm torn between waiting for a potential correction and reversal or beginning to scale in more cautiously. One idea I'm considering is a measured approach starting with, a 5 base, I would say, I assume they mean 50 basis points. I'm going to assume 50 basis point adjustment per week over the next 4 to 6 weeks. This would enable me to gradually build exposures in case the momentum continues, while also keeping some flexibility to respond if a pullback develops. I'd really appreciate any thoughts or feedback on this. As new members, some of us missed the great entry point you flagged last fall in gold, which makes it psychologically more difficult to initiate a position after such a relentless move higher. Thanks again for all the guidance. Appreciate the kind words and grateful to be, helping this client and all of our thousands of clients around the world manage their portfolios with an eye towards retiring on time and comfortably. If your goal is to manage your portfolio as a retail investor, to whip it around and just trade and be trading and trading and trading, I could point you that way if that's what you want to do. What we do here at 42 Macro is thoughtful, dispassionate, systematic investing that forces our portfolios to retire on time and comfortably and removes all the behavior heuristics, much like this, this question is loaded with behavior heuristics. So let me take a stab at just answering that, not with my own words or intellect here, but with just a couple things. So I'll start with Dr. Mo. Dr. Mo is very much still bullish on gold. So as long as Dr. Mo and or KISS are telling you to buy gold, you should feel comfortable buying gold. That's it. There's no more questions to ask. That is the signal. If Dr. Mo is green on gold, you should be green on gold. And so it's obviously that's sort of step one in the process. Step two in the process, we actually address in our KISS portfolio construction process FAQ, specifically in terms of helping new clients get aligned with the new allocation. So specifically, this question here says, what if I'm a new member and need to get allocated to a fully invested or near fully invested KISS from scratch? And you can say fully invested KISS or fully invested, position within KISS. It's the same question. And so our answer here is the same answer that I'm going to give this client. It's the same answer I've been giving our clients for years, the same answer I'm going to give clients until I retire and or die. It is always best to dollar cost average over time when allocating significant amounts of capital to asset markets. Dollar cost averaging provides investors the best opportunity to take advantage of price dislocations in asset markets to lower the cost basis of positions. Much like rebalancing, there is no right answer for dollar cost averaging, as much depends on the bandwidth of a particular investor might have to execute trades. The strategy that 42 Macro founder and CEO Darius employs, that's me, is to buy a maximum 1,500 basis points or 15% of its portfolio of a particular position each Friday afternoon until the desired exposure is reached. For example, the strategy would put a 60% position in stocks, or a 60% position in stocks, or 30% position in gold over a period of 4 weeks or 2 weeks, respectively. If let's say gold declined considerably on any weekday prior to any of those Fridays, then it is appropriate to pull forward that week's 1,500 basis point purchase to that day. There's no need to wait till Friday of that particular week. He repeats this opportunistic process each week until the position is filled. So again, what I try to do when I'm dollar cost averaging into positions is, okay, I basically give myself 5 days to build up 1,500 basis point position. I don't have a time to sit here and trade my portfolio all day, so I usually attack that whole 1,500 basis points at once. But I wait for a big down day each week that I have 15 basis points of position to allocate. So if I'm trying to build let's say a 30% position in gold, which is what KISS currently has and has had for quite a while, if I'm trying to build that 30% position in gold, that means I'm trying to get involved in the course of 2 weeks, 1,500 basis points in the first week, 1,500 basis points in the second week. And what I'm trying to do is force myself patience up until that Friday to wait for a big down day to take advantage of. If there's a big down day, let's say here on Tuesday, then I don't have to wait for Friday to allocate that 1,500 basis point position. I can just say buy it on Tuesday and then wait for the following week to activate that next tranche of 1,500 basis point purchases. Again, there's no right answer for dollar cost averaging. This works for me based on the frequency that I wish to intend to trade my portfolio. This works for me based on my own personal observation of what I find to be the best practices and not best practices. But again, there's no right answer. There's not a lot of right answers to a lot of things in investing. So just be aware of that. Whatever works for you, just build a dollar cost averaging program that is, consistent with your, attention span and how much time you have to open your account and actually execute on the DCA program. And if, this works for me, I'm obviously an incredibly busy guy. So if you're an incredibly busy person as well, this may work for you. But if you are not an incredibly busy person and you have all day to dollar cost average into positions, then maybe you can spread it out over a period of weeks. And maybe instead of 1,500 basis points, it's a smaller amount. So again, there's no right answer. This is what I like to do, and it works for me. And if it works for me, it's likely to work for you because I'm a highly regarded institutional investor. So I appreciate you guys. We'll wrap it up there. Darius still here presenting our macro minute for Tuesday, April 22nd, 2025. Best of luck out there. We'll catch you back here tomorrow. Cheers.